Ultra-high net worth individuals routinely grow massive portfolios while legally reporting almost zero taxable income. This outcome is highly engineered. It relies on strict adherence to established legal definitions. The core mechanism enabling this is realization. Realization is the legal trigger, such as selling a stock, that converts paper wealth into a taxable event. The U.S. tax code only taxes realized economic events, not the steady accumulation of wealth. To understand how this works, we will reverse engineer the exact mechanics of tax loss harvesting and wash sale restrictions. These mechanics pave the way for a three-step endgame, the buy, borrow, die architecture. This raises a philosophical controversy. Does the execution of these extreme, edge-of-the-law strategies violate an accountant's professional duty to the public? Before we can judge the morality of aggressive tax avoidance, we must first understand the rigorous mathematical and legal boundaries that define it. Tax loss harvesting, or TLH, is the foundational strategy for mitigating capital gains taxes. TLH is a technique where investors intentionally sell assets at a financial loss to reduce their overall tax burden. By realizing losses on depreciated assets, an investor can directly offset capital gains generated elsewhere in their portfolio. There is a secondary benefit. If the harvested losses exceed the gains, an investor can use up to $3,000 of those losses to offset ordinary taxable income for the year. Any remaining harvested losses are pushed forward. The tax code allows these excess losses to be carried into future tax years indefinitely. The quantitative impact is significant. Academic research from MIT and Chapman University suggests tax loss harvesting can boost a large-cap stock portfolio's returns by as much as 1.1% per year. The government, however, introduces a strict friction point. An investor cannot simply sell a stock to claim a tax loss and immediately buy it right back. This restriction is codified as Internal Revenue Code Section 1091, commonly known as the wash sale rule. The IRS enforces Section 1091 to mandate a meaningful change in economic substance. For a tax deduction to be legally valid, the investor's economic position must actually change. This timeline illustrates the exact parameters of the 61-day wash sale window. It covers the 30 days prior to the sale, the day of the sale itself, and the 30 days after. If an investor buys 100 shares at $1,000, sells them at $750, and rebuys them at $800 within this window, they trigger the rule. The mechanical consequence of triggering this rule is absolute. The IRS officially disallows the $250 loss. The loss does not disappear. It is legally forced into the cost basis of the newly purchased shares, raising the baseline of the new $800 purchase to $1,050. Wash sales function primarily as a mechanism of tax deferral. They push the tax benefit off into the future until a non-wash sale finally occurs. There is one critical exception to this deferral rule, involving retirement accounts. If replacement shares are purchased within an individual retirement account, or IRA, the loss is not deferred. Since an IRA is a tax advantage tool for retirement savings, under this rule, the tax loss is permanently destroyed. Tax loss harvesting and wash sales operate as a highly technical game of deferring taxation by navigating the definitions of economic substance. This groundwork enables strategies that aim to eliminate realization entirely. Moving beyond deferral, we enter the architecture designed to bypass realization altogether. This flowchart illustrates the buy, borrow, die framework, a three-step triad utilized by wealthy households to extract liquidity without triggering taxes. Step 1 is buy. Wealthy households acquire highly appreciated assets like stocks, bonds, or real estate. As long as these assets are strategically held, they compound and grow entirely untouched by income tax. Step 2 is borrow. The household extracts cash by borrowing heavily against the growing value of the portfolio. The legal loophole enabling this is straightforward. The government does not tax borrowed money because debt is not legally recognized as realized income. This structure allows the family to fund luxury lifestyles and access immense liquidity indefinitely, completely tax-free. Step 3 is die. The benefactor holds the original, highly appreciated assets until their death, leaving them to an heir. This triggers a legal maneuver known as the step-up in basis. The step-up in basis is a tax provision adjusting the cost of an inherited asset to its current market value, rather than original purchase price. The code artificially resets the asset's baseline value to its exact market price at the time of death. As a result, the entire historical accumulation of capital gains liability is legally and permanently wiped out. By utilizing debt to sever the link between liquidity and realization, the buy, borrow, die strategy allows wealth to be endlessly extracted while legally erasing the tax burden upon inheritance. We now pivot from the cold mechanics of tax law to the fierce academic debate regarding professional ethics. The central controversy asks whether engineering these aggressive, edge-of-the-law strategies violates an accountant's duty to society. A popular utilitarian critique argues that tax avoidance is unethical because it deprives the state of funds required for public services and poverty alleviation. 19th-century economist Frederick Bastiat provides a counter to this utilitarian assumption. Bastiat introduced the economic concept of the seen and the unseen effects of reallocation. Applying Bastiat's logic, government spending programs are the seen benefits of taxation. The unseen effect is that the coercive extraction of taxes distorts the market, diverting resources away from where the public voluntarily chose to allocate them. Shifting from utilitarian economics, we encounter the rights-based argument championed by philosopher John Locke. Locke defined the concept of natural rights, arguing that individuals inherently own themselves, and by extension, the fruits of their own labor. It is necessary to differentiate natural rights from legal privileges. Government-provided benefits are legal entitlements, not moral rights that justify taking another person's property. This directly addresses the fair share fallacy. There is no objective definition for fairness in taxation, beyond subjective political mandates. This philosophical framework challenges the common assumption of harm. It suggests that if taxation is viewed as a coercive extraction, using legal avoidance to retain property does not necessarily violate a third party's moral rights. This challenges the flawed assumption that an accountant acts as a partner or fiduciary to the government revenue authority. The true principal-agent relationship dictates that the accountant is engaged strictly to work in the best interests of their client. This aligns with the core ethical directive of the AICPA Code of Conduct, representational faithfulness. The AICPA is the American Institute of Certified Public Accountants, the national professional organization setting ethical standards for the industry. This duty requires that the public interest is served by providing accurate, unbiased financial data. This accuracy is critical because it ensures that third-party economic actors, such as creditors, investors, and suppliers, are not defrauded by inaccurate reporting. The accountant's true obligation is to reflect economic reality, not to maximize extraction of government revenue. Navigating the technical labyrinth of wash sales, tax loss harvesting, and the buy, borrow, die framework aligns with the specific requirements of the tax code. Ultimately, the professional maintains strict representational faithfulness, operating safely within the exact legal boundaries of a coercive tax system.